This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Charles Hugh Smith, well-recognized writer on the web, who is the publisher of the website of2minds.com. Good morning, Charles, and welcome back to our second session this week.
Good morning, Gordon, and thank you for having me on the show.
As I mentioned on our previous shows, I asked Charles to join me on Macro Analytics in 2012 because of his clear and honest thinking and bold writings, which clearly illustrate a number of the themes that I outlined this year in my 2012 thesis paper entitled Financial Repression. These are all contributors on the roadway to a potential fiat currency failure, a cycle that was publicly and visibly kicked off with a collapse in the U.S. housing market, as shown on the right side of this chart, which I have up now and is in fact the subject of today's discussion. Before we begin, Charles, I need to cover off some administration. We have some slides to guide our conversation, as we often do, that Charles has brought with him. I would ask our listeners to open the slides to full screen viewing. You need to open the slides to properly see the detail we'll be discussing this morning. There's an icon in the bottom right corner that by clicking it will allow that to happen, and then the slides will automatically advance as we go along. There is a box below the slides where you can make comments, and I've asked on our previous show, I'd like you to make some if you can, so that Charles and I can address them in the next show. Charles, as I mentioned, the topic this morning is on the U.S. housing market, which I am going to let Charles describe here in a moment with some charts he brought with him. But before we do, I thought I would share with you these representations of what is happening in the U.S. housing market. The chart on the left shows the median single-family home priced in something other than U.S. dollars, which have been steadily falling in value until the last couple of quarters. The second chart shows the median single-family home price if we were to adjust it using the government's claims on what inflation is, in fact, the CPI. And heaven help you if you don't believe that the CPI is in fact valid, and in fact it's understated, because it would say that this chart would be even more dramatic. Charles, your views on these two charts we're looking at?
I think the key point you're making here, Gordon, is essential that we understand that housing is deceptively priced when we think of it in dollars only, because a house could stay at, say, $100,000 in value, but if the dollar has lost 30% of its value, or the equivalent of 30% inflation, that house is can't sell it and buy the same amount of goods that you could 10 years before. And that's what these charts tell us.
That is precisely the point. The argument that I hear all the time is, yeah, well, I live in America, that's what I sell, and that's what I'll buy, and so it's just what it's worth to me. You're sort of right. Maybe the operative word here is what it's worth, because when you sell it, what does it buy? And I can tell you it doesn't buy the same number of loaves of bread that you used to have or could have had before. Because in fact, by printing money, the government is in fact financing itself out of the price of your house effectively, out of not the purchase price, but the value of that house, or the value of that asset. And this is the asset transfer that's actually happening as we debase currencies. And I think that one of the flaws that we as Americans have, Charles, we're so centric on America that we actually forget what currencies mean. If you're a non-American, live around the world, you live and die every single day paying attention to what your currency is trading at against others. You look at businesses, you even report earnings, are always different currencies. But we've had this luxury, because we're the global reserve currency, of not worrying about it. It's time for you to start worrying about it. You need to start worrying about what the dollar index value is, because if nothing else, that's central to what the value of your retirement plan is worth, or what it's going to buy. Am I overstating that, Charles?
No, not at all. Well said, well said.
The first slide that you brought with you this morning I have up here, which is also not a very pretty chart.
Yes, the reason why I brought this chart and why you selected it is that obviously Housing depends on a number of key drivers. We can identify those as income, wages, earnings. People have to make enough money to support a house and the property taxes and the maintenance. And then another key driver is demographics. Is the population expanding rapidly? Is it stable? Is it stagnant? Is the population of people who can afford housing, is it growing or is it declining? So this chart talks to the first driver, which is disposable income. And we can see that labor, like earned income, that the labor share of the U.S. economy has fallen off a cliff. In other words, the amount of money of the national income that's going to wage earners has dramatically declined. And that suggests that there's less income flowing into households, and that would mean less income that can be devoted to housing. And so that basically if housing is a chair, you kick out the income side, then you've removed a key prop of the whole housing market.
What this echoes to me, Charles, a little separate subject, is Henry Ford, when he was making his Model Ts, and we didn't have a middle class at the time, really believed that he needed to make sure his employees made good money so they could afford his Model Ts. But he was really echoing that the better the middle class was and had money, the better the economy would be. And what this chart is saying is our middle class, and we're going to talk about that in another session, our middle class doesn't have the money. And it's not growing at the rate of profits, for example, in corporations. And what's kicking the can right out from under, or kicking the chair rather right out from under, is the disposable income's no longer there to support housing and support other things. And this chart just brings it out in spades.
Yes, that's exactly right.
What's going to upset it? And, when I look at housing right now, and I clearly, the drivers to me, are jobs, and I don't see that changing because I think it's a structural problem. I think it's disposable income, and that's collapsing especially when you look at real rates that we have, and that's a discussion. I see demographics changing dramatically, and I think one of the charts we have here next is just looking at household formations, which is a discussion in itself, and perceptions about whether housing is in fact a good buy. I'm watching rentals, and the youth today have a whole different attitude about being debt slaves and whether they want to even be involved in housing. I'm not trying to pass judgment on that. I'm saying these are shifts that are generational, they're protracted, and they're not something that's about this year, next year. I think they're about this decade. And so I don't see housing coming back. Matter of fact, I personally think we have some more downside to go.
And I think you're right, Gordon.
I got a lot of bad news here this morning, don't I?
Well, we have to deal with reality. Yeah, fantasy is not going to make us money.
That's right.
And so this household formation chart is interesting because it shows that a number of factors. One is, of course, that the baby boom, which came of age, and especially home buying age in the 70s and early 80s, was an extremely large generation of about 63 million people. And so the following generations are simply smaller in size. And so part of this household formation downtrend is simply that even though the population of the United States continues to rise, the population at peak home buying is actually declining. And another part of this housing formation secular decline is that as housing has become more expensive in terms of hours worked, in other words, your disposable income, the previous slide, if you make less money and costs of living are going up, you cannot afford the house or apartment or condo you once could. And so say in the 70s when housing was cheap in terms of your disposable income, single people could buy a house. And a single person could buy a condo, pay the costs relatively easily out of their income. Well, as housing has become relatively expensive and wages have stagnated, single people can't afford to buy a house anymore. And so household formation is not just the raw population numbers, it's the number of people who can afford to buy a house themselves. And so this is another secular trend, that the idea that single people will be buying condos and households will be forming because of that I think is a trend that's ending. People cannot afford to buy a house on their own. They need to be a couple or a family or even several generations, as was the old model. And so this, I'll say one last comment about this. We can see that in the housing bubble, a whole lot of people went out and bought a house that they couldn't afford, and that was that gigantic spike. And then the housing bubble burst. It shows household formation hit a new low, and it has recovered, but it's only recovered to the trend line, which is still down.
You know, the rush into housing was, for those that remember, was, well, they're not making any more land, and therefore if I don't get in now, I'm never going to get in, and if I don't buy now, I'll never be able to afford it. And we pushed that envelope so far out as people thought it was an investment. Well, now it's come back to haunt everybody. But the point here is that people were pushing this hard because they didn't feel they were getting ahead with their savings or their salaries or their ability to improve their lot in life to the same degree they thought they should. And housing was the answer. Housing was the way that they could make money and maybe most importantly, they felt it was going to be the way they could finance their retirement. They were going to be able to sell this property, and therefore that was going to be the retirement. And we've had this removal as we've shifted pensions from defined benefits to contributory benefits in the last decade. And so pensions have went away. And so there's this huge gaping hole.
I'm glad you brought that whole subject up, Gordon. That is a critical element of our conversation here, that housing has become a speculative venture, that you were going to make up what you've lost in wages and pension by speculating in the housing market, and that's like the wrong approach.
This is actually getting to the core of this concept I talked about of financial repression, and part of that is to force it's a way of financing the government, and the government gets to spend the money first when in terms they put it into circulation or print it or create the bonds. But this gets too complicated for everybody. The way of thinking of it is right here as we think about housing. What do you get for every hour of your labor? And what did you get 4 years ago because the only value you bring is your hour of labor that you can contribute. So how much house does your hour of labor get you now versus what it would have got you 4 years ago? And so this is the issue that we have right now that's centered at housing, is the amount of debt that people have incurred. And this debt now is becoming harder to maintain. And what people don't understand is that there's a difference between being a lender and a borrower when interest rates go down. And for example, with the banks right now having huge amounts of outstanding debt, with interest rates falling, it's better for them. And it's because that value of those outstanding debts at present value become worth more money to them, as opposed to what is called present value of what they originally took it on. Conversely, it means lending money is not as attractive to them because they have questions of the collateral value going forward that's securing that lending as they put it out. And conversely, it's terrible for the borrowers who've now got being saddled with a collateral that's collapsing in value, things that we all understand. But I don't think people fully understand as a macroprudential strategy how well thought out it is by our public policy setters who are trying to manage a $15 trillion debt and probably close to $200 trillion in off-balance sheet unfunded liabilities and entitlements. The only way out of it is to print, but the question is, how do you print? And that's not a debate of whether we print. The question is, how do you do it? And financial repression is an example of how you do it.
Yeah, and let's look at the next slide, which is about income. And this is the real household income. That means it's adjusted for inflation by the CPI. And you can see that virtually all income groups by age bracket, everybody under the age of 65 has seen their wages decline since 2000. This is the real wage. And of course, if CPI, as Gordon mentioned, is understated, then this is an optimistic view that people's wages have actually declined in terms of purchasing power by an even more significant degree. So this also fuels that whole speculative desire to get into housing in the hopes that your house will make up everything you've lost in wages.
Charles, that was the point I was going to make and I didn't get to, is by financial repression, big part of it is to force you into more risky decisions, to force you away from savings because savings aren't worth it, and to force you into more speculative and in fact almost I would call gambling, to be able to make the money you think that you want to make. And you're taking on risks that you would have never taken before. Never taken before.
That's an excellent critical point, because basically that explains that the housing bubble, people jumped in the hopes of making a speculative sum of money to replace what they'd already lost, and instead they lost the bet.
Exactly.
Because they were gambling and they lost. Because that's what happens when you gamble.
Think of the pensioners today who had planned to retire, and they had planned that they were going to get 6 or 7%. And I have all sorts of people that I know that had good amounts of money, and they were being conservative. They thought their returns would be 6%. Well, they can't get that anymore. They can't even come close. But they still have a nut to make every month to pay their ongoing expenses as they're retired. So the decisions that they're making now to try and make that is pushing them into investment decisions that they 10 years ago would have said no way they would take, but now they have to do it. Or at least they feel they have to do it because they feel they have no other choice. Their house isn't worth what they thought it was going to be. They're not getting the money on the bonds they thought they would get. They're not getting it on the savings. What do? And they feel like they have no choice. And it's, in fact, when you're put in a box of no choice that you start to make these decisions. Example, as blatant as it is, we were paying the U.S. government to sell us a T-bond here a few months ago when it was negative interest rates. Well, even now they're next to nothing. I mean, pardon?
Yeah.
Now, how does that happen? It doesn't just happen, Charles. It doesn't just happen.
Yes, and so since housing is so critical to people's perception of wealth and household wealth, let's move on to the next slide, and I can talk a little bit about, again, the key point here is the income is not supporting the housing market. In other words, this chart is critical because it shows the number of people in the private workforce who have full-time jobs. And it's another one of the manipulations of data that we'll speak about in a future show, that the government counts jobs as if you work 1 hour a week, you're counted as the same as a person who worked 40 hours a week. You're both employed, so yay. But of course, the only job that supports a mortgage is a full-time job, or nowadays 2 full-time jobs. So if the number of people with full-time jobs has stagnated or declined, then that's a huge headwind for housing. And as this chart shows, the number of people in the private workforce with a full-time job is basically the same as where it was in 1999.
You know, Charles, you're on to a major point, which is a show in itself. It's not about the quantity of jobs, as bad as it is, but it's the quality of the jobs. And today, the biggest problem, besides quantity, is the quality. That is, well-paying jobs. So many people have jobs that don't pay enough to live on, don't pay enough to exist, or are having to have 2 jobs. Or more in some cases to get by. The government doesn't spend enough time on what the quality of the jobs are. And we have so many people that are below the effective poverty line who are working, Charles, and can't get by. But we don't measure that, do we?
No, and the issue here in terms of housing is they're really not able to afford to buy a house.
Exactly.
That's a negative for the housing industry. This chart speaks to your point, Gordon, of how interest rates have been driven down to 0. And one of the drivers of that policy is a desperate attempt by the central planners to support the housing market and the housing prices. And so they've tried to make mortgages so cheap that if you have a pulse and some sort of income, that you can get into a 3% down FHA loan and prop up the housing market. But this is just a reflection of that super low interest rate policy that you described.
Mortgages now, Charles, are at the lowest rate they've been since the Second World War. And yet housing's going nowhere.
Yeah, that's the key point. Housing's going nowhere despite this tremendous subsidy.
Because nobody's got any money.
Yeah.
Or you don't have real money.
That's right.
You don't have money that would have bought you what it would have a couple of years ago. And if you think that inflation is, shadow stats numbers that they believe the inflation rate is north of 10%. 10% in 2 years is 20%. Who could absorb that? So that's the rate at which the compression is happening, and it's showing up. And especially when you add gas and that sort of thing. That's why with these historic low, it isn't about credit standings, and it isn't about the bank lending you the money. Nobody's got the money in overall.
That's right. And that's reflected in this. The next chart here is of mortgage debt. This is the rate of change, or we could call it year over year change. Sometimes we call it. It's the change. It's the rate of change from a year ago. And you can see the bubble is here, that mortgage debt shot up in the bubble, and then the rate of change dramatically declined as people could no longer borrow more money. Their house had lost its value. They were underwater. Their wages are stagnating. And so this just shows that the idea that mortgage debt can grow is an impossibility. There's nothing to support more mortgage debt, not in housing values and not in rising incomes. So that's sort of like basically saying the housing market's a dead duck because no one can borrow more money.
Charles, we're coming up against our hard line. Is there any other chart that you wanted to show us here this morning?
No, I think done well on these, and you can move to your final chart.
Well, I just wanted to show this chart, our couple charts I had up before we leave. This is a Lennar stock price. And as an example, this is from one of your presentations, Charles, you had, and you'd labeled it an AB here. And for those technicians out there, an ABC says you have a C wave, another wave down. And it's my opinion. And as I said, we have another wave down in housing, and I expect it was maybe it's in the range, my opinion, somewhere in the 15 to 20%, with one big caveat. If the government accelerates the rate of printing, which I'm expecting, they may be able to hold it up in nominal values. So in fact, housing may start to flatten out and bottom out here in nominal values. But in real values, you've got a C wave down, which is probably another 20% in value. So the amount of hours you're going to have to work just went up to offset what you thought you were going to get out of that house that you were going to retire on. And you think that the housing bubble right now has burst? We haven't even begun to feel it yet, Charles, and this is showing the amount of, at least some of the official numbers of the shadow inventory that's sitting out there. And it's not even effective because there's so many houses that have not been foreclosed that they're not even collecting mortgages on right now, payments. There's people that have been living in their houses for multiple years now that haven't paid any kinds of mortgage payments. Because they don't want the houses back because they'll just drive down the housing prices. They're not being protected. Then you have to service them. It's better to have somebody in it. At least this is how the banks would argue. But this inventory that's outstanding is in the many millions of homes that's still got to be cleared. And so there's some fairly big downsides. You know, and Case-Shiller was just out. We saw what was it down 3.6%, nearly 4% in the 10-city index, and same kind of number, 3.5% in the 20-city index. Where, you know, and at times we were talking about renting here earlier. The median rent to sales price ratio has almost doubled from 34 to 53 since the 2005, which is a double, which just says the amount of people that are now choosing to rent versus buy. Just think of what it's also doing to the demand side of the housing. So there's a lot more downside, which the bottom line to this too is this is going to put pressures on the banking industry that still has vast amounts of commercial and residential real estates on at full value. They have not taken the write-downs that they have to take. So I'm very worried about what I see in the future here over the next year or so. Any last comments and how people might learn more about your writings, Charles, and more about your website?
Please feel free to visit me at of2minds.com.
Talk to you in a couple days.
Okay, thank you, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.